Welcome to Tax Teach. I hope you're all having a great day. My name's Sean. I'm a certified public accountant specializing in taxation. Before I get into the video, I just want to say I apologize for not posting more regularly. I've been busy with work and, it's been crazy with the pandemic and all these other things going on in my life. So that's prevented me from making videos more regularly. Moving forward, I'm hoping to post more often, hopefully weekly, but we'll just kind of see, as months go on. That being said, I wanted to create this video because I know the current housing market's kind of crazy. A lot of people buying, a lot of people selling. And I wanted to dedicate a video to hopefully make you all aware of a certain exclusion out there that can help you if you sell your house. So without further ado, let's get into it. Before we get into the exclusion, I want to kind of explain the concept of taxation on a house when you sell it. So first things first, when you buy a house, you get a basis in your house. What I mean by that is, let's say you pay $300,000 to acquire a house. You can include some of your closing costs as well. Linked below, I have publication 523. It's an IRS document where you can kind of go over the things I go over in more detail. So feel free to look at that. It's going to be in the description down below. But anyways, let's say you pay $300,000 for a house. That is your basis in your house. The basis in your house can increase. For example, let's say you add improvements. You add hardwood floors to your house. Maybe you add a new bedroom. You kind of keep track of those additions. So let's say you buy a house for $300,000 and then you add home renovations around $50,000. Your total basis in your house will be $350,000. And you're going to want to track that throughout your time owning the house. Because when you eventually sell the house, you're going to have to use the basis along with your actual proceeds of the house when you sell it to calculate how much gain. So let's go back to the example I had. You pay $350,000 for a house. And then eventually you sell your house for $450,000, right? You use your fair market value of your house when you sold it for the $450,000, and you would subtract your basis, your $350,000 of costs / improvements you had in the house to calculate your gain. And so in the example I just had, $450,000, you sold your house, and then you have your basis of $350,000. You have $100,000 in gain, which normally would go to your tax return and it'd be taxed. But under the Section 121 exclusion, you'll be able to exclude all or most of that gain, which I'll go into here right now. So Section 121 exclusion is if you own a house for 2 years out of a 5-year period, and that's your principal residence for those 2 years, then you can exclude up to $250,000 in gain if you sell your house. And I think this is very helpful to have in the back of your mind. Because imagine you're a homeowner, right? You're a year and a half in and you're thinking, I want to sell my house. You might consider, okay, I should probably just stick around for another 6 months and I can get this large exclusion from any gain I get from my house, right? Which is helpful. And if you're married, filing jointly, you can get up to $500,000 in gain excluded from your tax return. So to go back to the example I had earlier, let's say you buy a house for $300,000, you add $50,000 of improvements, so you have a $350,000 basis in your house. And let's say the Section 121 exclusion applies, right? You've lived in the house for 2 years. It's been your primary residence over a 5-year period. When you go to sell that house, you have $250,000 in gain you can exclude from your tax return. So back to our example, $350,000 plus $250,000, you could sell your house for $600,000, and none of that gain would show up on your tax return. And I think this is, if you don't have a tax background like myself, you might not have been aware of this exception, and hopefully moving forward, you can have that in the back of your mind. And that's the general rule of Section 121, but there's also some particulars I'm about to go over here as well. So some particulars, or I should say exceptions to the general rule. One, for example, is if your spouse passes away throughout the year, you don't need to meet that full 2-year general rule. You can prorate the exclusion. And what I mean by that is, let's say you and your spouse live in a house for 1 year where it's your primary residence. then your spouse passes away. If you're married filing jointly, you got that. Usually you have 500,000 exclusion, but since you only lived in the house for 1 year, you do a proration. And what I mean by proration is you do 1 divided by 2 because you normally need 2 years in the house to be your primary residence. So it'd be 50%. So you'd still get 250,000 exclusion. Another example is if you have to move because of work, there's a distance kind of limit. It has to be 50-mile difference. So let's say normally in your old work, you were 10 miles from work. You'd have to be 60 miles in order for you to get a proration of the exclusion. And like I said earlier, by proration, I mean, let's say you only lived in the house for a year. You would do 1 divided by 2 because you're required to have 2 years, and you get that 50% exclusion of the full amount that you are entitled to, whether it's 250,000 if you're single, or 500,000 if you're married filing jointly. And there are some other exceptions to the rule as well. Linked in the description down below, there's a publication by the IRS, publication 523, where it goes into more detail about this section, section 121, gain on your house exclusion. So if you're interested in that, I encourage you to look at that and just see if any exceptions apply to you, maybe moving forward if you're thinking about moving somewhere. There are also some other rules to be cognizant of. For example, let's say you use your homeowner, use the exclusion under section 121. Usually you can't use that exclusion again for, I think, around 2 years. So that you can't use it over and over again. There's a limit to how often you can use the section 121 exclusion. So yeah, all the information is more in depth in the publication linked below. The purpose of this video was hopefully to make you all aware of that there is an exclusion out there. If you're living at a house for 1.5 years, you're like, okay, I just need 6 more months and I can exclude all the gain related to my house. Because it can be costly, right? Let's say you stay at a house for 1.5 years and you just decide to move for whatever reason. You might be out of a gain of up to 250,000 or 500,000, of your house. And that being said, that is, the way houses appreciate. It's really unusual for a house to appreciate so quickly over 2 years, but houses do appreciate over time. And I just wanted you all to be aware of this rule out there, the section 121 rule, where you can exclude $250,000 of gain if you are single and $500,000 if you are married filing jointly. So that wraps up the video. I hope this video has been informative. I hope you've learned a little bit from this video. If you enjoyed the video, hit the like button. It lets me know that I'm making okay videos for y'all to learn from. Also, if you want to hear more tax tips and just informational videos, hit the subscribe button. It'll just keep you aware of any videos I post in the future. I appreciate you all watching the video, and I hope you have a great rest of your day.